Hello everyone, I am Ankit Kanodia, founder of SmartSync Services, a SEBI registered investment advisory firm based out of Ahmedabad. Welcome to the 18th episode of Mission Smile guest webinar. For those who are joining for the first time, Mission Smile stands for making new stock market investors learn it through engaging research. Guest webinar is an initiative where we call veterans from the industry and learn from their rich experience in the stock market. Speaking of veterans, we have one with us today on this 18th episode of Mission Smile guest webinar, Mr. Gaurav Sud. While Gauravji needs no introduction, but the format of our session demands it, and hence I'll keep it very brief. IIT Delhi, IIM Calcutta, worked in known names like KPMG, Wipro, WNS, Global, and then from 2006, he became a full-time investor. His firm's name is Kanav Capital Advisors, and he has been using three different styles of investing: long-term investing, special situation / arbitrage opportunities, and options trading. We did a podcast with Gauravji 2 years back where we covered a bit about all three. But today we'll focus, as the topic of our session says, understanding option trading. How to smoothen your equity curve by trading in options. So the format is pretty simple. Gauravji has a very short presentation that he will run for say 30 minutes. And then I'll ask him a few questions before opening it up for all of you. So that if you have any questions while he is presenting also, you can type those questions on the chat box. Now, before we start the presentation, Gauravji, I think you touched upon this briefly the last time we met here. I would just request you to start from the beginning, as in, I would want you to start from the time when you became a full-time investor in 2006. What happened after that, and what led you to develop interest in option trading before we start the presentation. Over to you.
Thanks, Ankit. Thanks for having me on your seminar. It's always a pleasure to be here. I don't do it too often, but it's always great to interact, and I think doing a great service in terms of trying to educate people to make intelligent decisions. See, it's all probability that no decision can always be right, but just to understand the probabilities around it, it does make a lot of sense. So coming back to me, I kind of got interested in the stock market way back in I think 96. So I started my first set of investments in 96 when I was in the third year of IIT, and and kind of hooked onto it. Got lucky in reading about Buffett early, and just hooked onto that concept. Wherein the basic premise was that stock prices are not just prices moving on a ticker, but they represent an underlying company. And most of those companies have a intrinsic value. And when you want to buy a company, you try to buy it at a discount to the intrinsic value. So that's the broad logic that I bought into at that time. I got seriously into investing in 2002, and I was lucky enough to have that great bull market of 2003 to 2007. It was one of the strongest bull market that India has ever seen, and it was very broad based. Before that, there was this TMT run in 99 2000. But that was very focused on the new technology companies, new age companies, the dot-com boom, as they say. Uh, but after that crash, valuations were pretty cheap. That's the time I got in, and there was a great run. And the index itself compounded at more than 30% for the next 4 years, and there were many stocks that kind of moved up 30, 40, 50x. So that's the time I kind of got serious about it. It seemed making money was a lot easy, and it came to a point where I got so enthralled by it that keeping my work job became a distraction, and I was keen to quit. So I had been interacting with a few other investors, and finally in 2006, I quit uh, and continued with my investing. I had no fear of the downside. I always thought that it's since you're making money so easily over the last few years, my fear of the downside was absolutely not there. And come 2008, which is the Reliance Power IPO, which was kind of topped out the market, and uh, s- and a big correction came in January and February, and while it distracted me a bit, but I kind of thought that it's a bump in the journey, and I continued investing. And then the big hits came in September and October of 2008, which were so dramatic that they were soul searing. So my portfolio uh, had a drawdown of more than 70%. Uh, and majority of my net worth was on my portfolio. So I had absolutely no liquidity. Like even if I have 10,000 in my bank account, the next day it would be spent. I would end up buying some stock, some of the other stock. So that drawdown, I was absolutely not prepared for it. And when it came with the ferocity it came, it just shook me up. And I have talked about this angle many times. And uh, when it hits you, you don't realize how it will impact your behavior. And in my case, the most stark thing I remember from that day is in November of 2008, I sold almost 30% of whatever remained in my portfolio and made a FD out of it. That's my safe space to be. And and then that FD continues till date as a stark reminder of what you end up doing if you're not prepared for it. So, anyways, that drawdown came. I quit my job, and given the situation, I thought that I had always this kind of a thought that given my pedigree in terms of having an IIT and IIM, finding a job would never be difficult. I looked out for a job, and that was a period in early March. I couldn't find a job for almost 3 4 months, and that again starkly reminded of where things were. And so I kind of thought that given what has happened, I really need to dig deeper into whatever has happened and try to see what ways I can generate income. So that's the time I started of thinking of generating income rather than just investments on whatever I'm doing. And during that intense period of, I read a lot. I really read a lot at that time, and got into two areas. One is what you call the special situations or the workout, which are kind of trying to generate short-term returns based on corporate actions that have been announced. Uh, and the second one I discovered was options. So, and options is pretty interesting. The internet was evolving. It wasn't as driven by social media as it is now. And came across a quaint old website, a website called fullyinformed.com. It was run by an lady sitting in a small town in Canada, and she was talked about how she was kind of uh, doing these covered calls on blue chips, largely out of American blue chips, and how she was able to generate and manage big drawdown. She highlighted even as the corrections happened in 2008, how she was able to handle those corrections. And that sparked the bulb in me, and thinking that if somebody uh, who's not kind of very savvy or wouldn't know the exotic nature of the derivatives, if she can do it, let me also put a hand. And that's how I delved into it. Uh, Initially, was like all beginners, I thought that it's easy to do, and did I used to sell deep out of the money calls without any underlying, assuming ki if they are 20% away. Or see what had happened post that big correction, the premiums on options had shot up, and so you could sell calls options very far away and still make a decent money on that. And that's what I ended up doing. But again, uh, an event came, which was the May 2009 election, where where the result was a big surprise and the index opened gap up. So you can imagine the individual stocks actually shot up on that day between 20-30% also. And I was caught naked with all those options. So, and I lost some serious money again in that particular event. So, so that again was a unexpected shocker for me. And so gradually toned down what I did, gradually built on those strategies over a period of time, and today have now kind of honed in on those strategies with the idea of trying to make anything between 12 to 24% annualized on those things. My aim is just to generate income on those. I don't look for big returns. I don't see options. I have actually never seen options as lottery tickets could build a fortune for you. But having experienced what I have and the way I use it, I have kind of now uh, do it for two reasons. One is to generate income, and the other part is to kind of hedge my portfolio for big drawdowns. And so that's kind of the backstory of where I come from. And the other angle that is so it's one of those two subsets. I'll delve into one of the subset, which is kind of using options to hedge your portfolio. So that's the topic I'll talk about today, rather than about what other strategies can be done in options. YouTube is filled with videos where people talk about all kind of strategies. It's an industry by itself. But I'm trying to put a word of option or caution in terms of what options can do and cannot do, and just talk about one of the ways I try to use it. So that's kind of the brief summary. We can go on to the presentation. I'll quickly run through it and then we can do the Q&A.
Yeah. Thank you so much, Gauravji. And I'll just make one point over here that of all the, I've shared this personally and in private with my friends, that of all the webinars or the investing Karwa sessions I had, I think I learned the most from Gauravji's session. The only reason being the kind of journey he has seen, both on the upside and the downside, and how openly he has shared everything in the past and also today. I think that is a big, big, big source of learning for all of us. So I would highly encourage all of you to watch that webinar as well. I think Harshal, you can share the link on the chat box so that everyone can have a look at it. In the meantime, I'll just share the presentation. Just let me know if you can see it. Yeah, I hope it is visible. I'll put it on slideshow. Yeah. Is it visible, Gauravji?
Yeah, I can see it.
Okay, great, great. So let me just do one little thing before we start. Yeah, yeah, I've disabled annotation. Harshal, thank you so much for reminding. Yeah, go ahead, Gauravji.
So can you move to the next one? So a standard disclaimer, I'm not registered with SEBI in any capacity. What I'm saying it can should only be foreseen as for educational purposes. There's absolutely no recommendation about anything. So yeah, we can move on to the next one. So that's briefly the things I'm going to talk about. Just a small touch up on what are options, the history of options, then an important concept in the way I construct my portfolio, which is hedging. There's a term that I learned called uncle point, so I'll talk a bit about it. Uh, Also want to highlight where things stand in the market as on day. It kind of reminds me of those old days in 2007. So, and then finally, I actually talk about how I use options to hedge my portfolio. Uh, and finally, some data points from the latest SEBI FNO report that has come in, just to give context to people, and close it by giving the key takeaways. So yeah, so so options are a subset of derivatives. In derivatives, there are futures. Futures are basically nothing but a financial contract that reflects the price performance of the underlying asset it's built on. So that future is pretty simple to understand, but options are kind of uh, why they're called options is it gives the buyer of an option to the option to actually do or not do something. So the option is entirely with him, and that's why these are called options. So metaphorically, I always like to highlight that options are are you can think of options as insurance. So the buyer of an option buys an insurance for some event, and the premium he's paying for the option is similar to the premium he's paying for buying an insurance. So if you have a car, say, and you insure the car to against accidents or potential damage to the car. So every year you buy that insurance, you pay a premium for that. And what happens is that in case a big accident, you don't want that accident to happen, but in case that happens, then because of the insurance, you know that the expense will not come to you, and the insurance company will cover it. So, so the buyer of an option is like the buyer of insurance. The seller of the option sells that insurance, which is kind of he acts like that an insurance company. Now, one can always say that the seller of an option is taking a huge risk. But what is happening is an insurance company doesn't insure one car. It is insuring thousands or lakhs of cars. So that pool that gets aggregated, and they are playing on the previous probabilities of how big a chance is there for the accident to happen. Accordingly, they price the premiums of those insurance policies, and they get the pool. And the idea is that whatever payouts they have to done on that pool of insured vehicles, that payout should be less than the premium they are getting. And so that's kind of how insurance companies being set. And to that extent, option sellers also tend to think like that. Uh, so an option typically has the following attributes: a call or a put. Call option allows the buyer to buy the underlying security at a certain price. So call is the option to buy, and a put is an option to sell. So every option has to be defined whether it's a call or a put. An option is always on an underlying. The option could be on Nifty, it could be on Bank Nifty, it could be on gold, it could be on an individual share. So the underlying is upon what that option is on. Because it's a financial contract, it has a defined period. It's valid for a certain period, and post that, the value it stops, and whatever the contract says has to be done has to be settled down. Strike price is so every option contract on an underlying, say on a particular expiry day, like Giving an example, say on Infosys, we have monthly contracts on which are expiring on I think 31st October 2024. So a month-long contract. So 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 one, it has to be a call on put. The underlying is Infosys. The expiry date is on a monthly basis, which is 31st October 2024. The strike price is the strike price on which that contract is made. So if today Infosys is at let's say 1800, so you will have options on with 20%, 20 points difference. So it could be, you will have options like at 1700, 1720, 1740, 1760, 1780. So the strike price is at which price is it being billed? And finally, the premium, which the premium is what you that particular contract is trading on. So the premium keeps on going up and down depending on what the buyers and sellers are doing, and just it will fluctuate just like a stock price. So for the life of the contract, it fluctuates, and the premium is influenced by multiple things. How long is the life of the contract? What is the uh, uh, implied volatility on the underlying security? So there are multiple. I'm not going to get into the depth. There's plenty of literature out there what all this means, but I'm just giving you a broad idea. And then finally, it's the moneyness of the option. So on the date of expiry, when the contract ends, there could be three kind of options. It's in the money, at the money, or out of the money. In the money option means that the option has an intrinsic value. And when we say the intrinsic value, say again coming to the point of uh, Infosys at 1800, say we have a 1750 call, say it is trading at 60 rupees, 1750 call trading at 60 rupees, and the stock price is at 1800. What it means is that the difference between the two, which is 50 rupees, is the intrinsic value of the option, and out of the total premium of 60, 50 is the intrinsic value. The remaining is the time value, which is 10 rupees. So in the money options are those where the strike price is below the market price in the case of calls, and the strike price is above the market price in the case of puts. So ATM is options are those which are whatever the market price of an underlying security is, the strike prices which are exactly at that price or closest to this price. Those are called the ATM, at the money option. And OTM options is when there is only a time value in the options, there's no intrinsic value. So coming back to the example, so if we have a 1800 price call, 1800 price Infosys stock, so 1850 strike call would be an out of money call. So these are the attributes. If you want to dig more, if there are any beginners out here, I would request them to. There are plenty of videos out there to understand what all this. Can we go to the next slide?
Yeah.
So, history of options. So, why options were devised, and it again comes back to the underlying premise. Options were devised because you want to build a you want to insure against an accident. So it was devised as a hedging tool largely to prevent against certain outcomes that were undesirable. So case in point, say you have a gold mining company. They're producing gold. They have an idea that how much they're going to produce for the year. So, but they are putting in all their efforts and assets to dig gold. Assume they're going to dig out or they're going to dig out about 100 tons of gold. Now, for them, the current price of say gold might be $2,200, and it's pretty profitable. But by the time they mine it, because every month they'll say they're digging out 10 tons, the price are going to fluctuate. So they don't know a year from now what the prices of gold is. And since they don't know what the prices of gold are, they don't know what their profits are going to be. So one way for doing that is for them to actually use long-term derivative contracts. So in this case, suppose gold is at 2200, they could basically buy the 2100 puts, which are 1 year into the future. That way, they are ensured that no matter what happens, at least they will realize 2100 rupee dollars per ounce for the gold they are manufacturing. So for manufacturers or producers, uh, options were devised as a hedging tool, and this goes back. There were informal contracts earlier, and formally uh, in the 1920s they came as over-the-counter products. It's basically a handshake between two parties about, and it's largely started in commodities to kind of help them hedge for the downside.
Gauravji,
Yeah.
in that gold mining example, just wanted your thoughts on uh, why would uh, an entrepreneur or the businessman would go for option and not for say forward contract or future contract over there.
So future contract, by selling the futures, they have already booked their sales. That is another way of doing it. But options allow you to kind of, in case if you bought say to the $2100 dollar put, so it allows you to hedge the downside in case the gold prices go below 2100. It allows you to realize $2100 dollars, but you are not capping your upsides. What if if the gold goes up to 2500? That is for yours to keep. So for many producers, they मतलब typically अगर आप भी कुछ करना चाहते हैं, आप कहते हो मेरी डाउन साइड बची रहे, अपसाइड तो मेरी होनी चाहिए, स्टॉक्स में भी तो यही चाहते हो आप.
Right, right,
So if a producer wants to keep his upside, then he buys these puts. In case he sells the derivative contract, the futures on that 1 year out, then he's kind of captured the current price. He doesn't have the upside, he doesn't have the downside.
right, right. Thank you so much. Yeah, please
Sure.
continue.
So options and equity started in CBOE. So CBOE is Chicago Board Option Exchange. There was a lot of literature coming out of Chicago University, and these kind of that literature allowed the exchange to make a standardized contract, and that's how it started in 1972. Uh, so in the 70s, then finally options started in currencies and bonds, but they were largely in the OTC market. OTC market means that they're not trading in the exchanges. They are kind of uh, uh, basically a contract between the buyer and the seller. So finally, they also started trading on the Philadelphia Stock Exchange in 1982. Then the interest rate options started trading in 1985. And finally, the current craze, which is the weekly and the daily option expiries, which is they finally started in 2005. So coming to the Indian markets, uh, in India, for many things, the change agent has been NSE. So NSE itself was formed, I think, in 1996. So in June 2000, they introduced index futures. 2001, they introduced the index options. And then finally, July 2001 is stock options were introduced. So that's largely the timeline. 2010, NSE introduced the currency options. And finally, the big thing, the which has really sparked the current option trading boom, which is the weekly options in Bank Nifty, which started in May 2016. So commodity options in October 2017, they started on NSE, but they were all MCX was already offering them as a product, but there was not much liquidity before. And then the other what my take is what kind of like turbocharged option trading was May 2023 when BSE, after all the struggles they had, they finally launched a contract, the Sensex weekly option, uh, which started on a Friday, and because there was no expiry on Friday, volume started coming onto it, and its success allowed them to launch a banking on a Monday, which was the second contract. So effectively, once that was launched, for every trading day of the year now, you have one contract that is expiring every day. It's a different contract, but every day of the month there is one option that is expiring for the day. So that's where things are. These are the option payoff chart. So if you graph and 1 and 2 are for the option buyers, graph 3 and 4 are for the option sellers. Now, the interesting aspect I want to highlight here is that if you look at graph 1 and 3 and you combine the two, then it comes at a zero. So what I so between the option and the seller, it's a zero sum game. Whatever one is losing, the other person is going to make. So depending on what one makes and the other loses is entirely dependent on how the prices move of the underlying security. So it's a zero sum game. In fact, I would call it a negative sum game because these charts do not factor in what we call the transaction cost, which is the STT, the exchange turnover charges, and finally the brokerage. So considering all those facts, it's a negative sum game. Option trading is a negative sum game, which I don't know how many of people realize what this means. Next one. So let me come to the other concept that I refer to. So hedging is a financial strategy that helps investors protect their assets and reduce risk from adverse market movements. So hedging is basically trying to protect yourself from the adverse movements in the market. So typically, uh, one way to hedge is basically whatever your exposure is on the underlying, you could just short a future on it or a derivative contract on it, which as Ankit asked. So you can use a future to if you have managed, like coming back to the gold example, if you are producing 10 tons of gold, you can short simply the 10 tons of futures. So effectively you're locking the price for that product at that point of time. So the whole idea of hedging is to minimize is to take a position which kind of helps you minimize the impact of market volatility or the market fluctuations. And yeah, just the previous one. So what is hedging? So again, coming back to the point, buying a hedge is like buying a insurance policy. So that's the thought process I want you guys to carry. So we can move on to the next one. So there is this term that I called uncle point. I discovered it the hard way in 2000 point. So uncle point in finance means the point at which you just give up. So as an investor or a trader, it's a drawdown on your portfolio or the drawdown on your position at which you kind of just give up. So in and the genesis of this term uncle point comes from the fact, see, in wrestling, when one guy pins the other guy on the mat, they continue doing it other till the point that the other person taps out. So he kind of puts his hand on the floor and does it 3 times to give the other guy that he's given up. So there's also a kids game which is similar to wrestling where the if in case somebody is in a position where the pain is unbearable, he will say uncle, and so that the other people stop torturing him, and that's kind of it. So that's the genesis of the point, uncle point, and I experienced it in full flow in 2008, and that made me kind of uh, rather than buying shares, I sold my shares in order to buy FD in November of 2008. So it was a rational decision, absolutely. But the pain was so much that this was the only way I could give an outlet to my angst. So the other aspect of uncle point is it is different for different people. This is not a common denominator. So a person, if his net worth is 100, and if the net worth comes down by 20%, one person may say, I have enough of it. I want to get out of this volatile asset. If somebody has a drawdown of 40%, he may say that that's my. So somebody is fine and he's okay with, he says that I'm okay with 40% drawdown. But what if drawdown that comes is 60%, 80%? So at some point, whatever asset they have left, they would say that, okay, this is it. I just want my asset in a safe place. So so the whole idea about this concept is that everybody has an uncle point. It could be a different for different people, but it makes a lot of sense for investors and traders to understand what is their uncle point. So at a level of drawdown where they will really start feeling the pain, and once they understand it, they can kind of fine tune their strategy to kind of handle it. So next one. So now I come to the current state of the market. Uh, the gist of it, I find the market pretty expensive. All of these slides highlight what is happening in the market. So an interesting aspect is that our stock market, we are talking calendar years here. Uh, our stock market hasn't had a decline year on year for now 13 years on a trot. These streaks are extremely rare if you go back into the 200, 250 years of the stock market history that is there. When I say the stock market history is not formal exchanges, but those in US there is enough literature to highlight how people used to trade between themselves also. So the streak of every year going up is extremely rare, and we are in the 13th year right. Uh, in terms of price and price to earnings, which is another metric, India is considered more expensive than USA also. So that it's India currently is the most expensive market. If people may not agree with that, then it's among the most expensive market in the world right now. Next one. So another indicator of what is happening is Bloomberg just shared this data that the buy recommendations of the investor or of analysts has started going down. So analysts are the most optimistic community. They rarely would give a sell report on a company because if they do so, the company stops giving them excess. So at uh, hold is just another way of saying that sell. So sell rarely comes from a buy side analyst, from a sell side analyst. So sales don't increase, but increase in hold implies that they're saying that sell. So the buy recommendations have gone down dramatically. So this is Bloomberg data. This data was shared in August. So again, this points to what is happening in the market. Yeah, next one. Okay, so I come to the segment which is where there's an absolute full-on bubble being built out. Uh, this SME IPO index, which was built by BSE, look at the values. It's currently at over 1 lakh, and which is a CAGR over the last 5 years of 227%, which is kind of unheard of. So clearly there is a big bubble being built out, uh, and it will not end in a good way. But the impact of the SME market on the overall Indian market is slightly less because all the SME stocks combined market cap would be less than 2% of the Indian market cap. It's a small pool, but absolutely going out of hand right. Next one. So this is a ratio that I have been tracking for the last few years. which is the ratio of the BSE small cap to Nifty. Both are indexed, both are published. So BSE small cap is made out of all the shares that are listed on BSE but are not part of any index. So Sensex or the Sensex 100 or whatever, all the BSE mid cap, all the shares that come. So whatever remains and is listed will be form part of this index. Currently, this index has about 870 stocks, and so it absolutely represents the bottom of the market in terms of market cap, and I would like to say also in corporate governance. So this is a ratio which kind of highlights how expensive they are vis-a-vis the underlying market, which is represented by Nifty. So this ratio I've been tracking. So from 2020, it was 1.1, and it has gone as high as 2.25, and currently at 2.20. The last highs that were made were absolutely at the top of the 2007 bull market. So as I said, I'm trying to see signs of what is happening right now in terms of what happened in 2007. And you can see that these kind of spikes are also happening, and the previous highs are getting hit. So for me, this index is a clear sign of caution. Next one. Uh, Nifty price to book ratio. So book ratio, B is the book value out here. So book value is nothing but the money that is raised from the market, and plus all the retained earnings divided by the number of shares. So book value it represents of whatever money the business has saved, has raised from the market or saved from its profit, and the price uh, is what the current valuations are. So these valuations typically they are in the range of 3 to 3.5. Uh, they hit a high of 5, but I would say that towards the end it looks more muted than it actually is. What happened was Nifty started reporting book value and earnings of the consolidate on a consolidated basis, the listed company and all its subsidiaries uh, and associates. And before that, only the listed companies' net worth and earnings were taken. So once that change happened, that is what created the big spike down from a level of 5 to 3.5. So if we add to it, then we clearly are at a if for a like-to-like comparison, we would say that the book value is above 5. Price to book value is above 5, which again is very high in the way I see things. So next one. So this brings us to the point. Then what to do if you feel the market is expensive? I definitely feel that the market is expensive. And you would hear this chatter, most of the old timers. Like I spent more than 20 years in the market. This is the third decade of mine in the market. And we all having seen the valuations and the previous big corrections, we all do feel that the market is overvalued. There is a new breed of investors that has come post COVID who are fearless, and they are going for the jugular. So there is no fear of the downside. Exactly my position in 2007. Uh, so, so that's a new breed. They are fearless. They continue to stay invested and playing the aggressive games in the market. So they would have a different opinion, but I do feel that things are getting more and more expensive. But then it brings to the other point is that uh, is this the top of the market? Will can things go more expensive or whether the correction kicks in? The point is I don't know. So the quote is this attributed to John Galbraith, which is there are two kind of forecasters: those who don't know and those who don't know that they don't know. So if you just think over it, absolutely nobody has the ability to say what the market will look like a week from now, a month from now, or a year from now. All are making like throwing darts in the dark. They don't know where it's going to land. So, so I firmly believe that the ability to predict is not there with anybody, no matter whatever tools they deploy. So then, in that case, if that ability is not there, so what are the choices one can have? So one is that you maintain the status quo. If you are invested, you keep stay invested, and you kind of keep churning the portfolio as you deem fit. Or what I used to do is I used to do when I felt the market was getting expensive, which is what I did in 2014. So from 2014, when Modi came in, so the market started, the rally started in August 2013 when Modi was designated as the prime minister nominee from NDA Alliance. So the market started climbing post that, and as the stocks got more and more expensive, I started selling. Starting from 2014, right after 2016, I came on almost 40% cash. So I stayed in that cash with the basic premise that whenever the big correction comes, I'll deploy that cash all over again in the market. So there was an opportunity cost from 2016 to 2019 of not deploying that cash. And when the big correction came, which was March 2020, I was again scared like the rest of the world, and I did not deploy the money all over again. So, and finally, I again started deploying that money towards the end of 2020 and 21. So, point I'm trying to highlight is that even though I took a cash call, I let go of all the upside that cash could have generated, but simultaneously, uh, the whole premise that this was predicated on when the correction comes that I'll invest. Uh, I still did not end up doing that simply because the reasons for the corrections could create fear in you, which do not allow you to invest, at least in my psychology. So that was a self-defeating purpose. So now I would say that I'm fully invested, but I'm now trying to hedge my portfolio. So I'll try to highlight what that means. Next one. So hedging the portfolio using long dated put options. So so I just highlighted that I don't feel that I or anybody else has the ability to predict what the market is going to do. Uh, Sitting on cash has a big opportunity cost. So how does one hedge the portfolio? Uh, there are two ways to do it. One is to short the index, and that kind of in case the market corrects, you make money on the index, but you also lose money in the market in the sense that if the market goes up, you keep losing money. So, so temperamentally, I don't want to, having learned what I've learned, I don't want to put a cap on my upside. So my strategy largely has been, uh, so the only way to hedge it is to buy long dated put options. Now the long dated put options are there only on Nifty index. So Nifty index has put options that are go 3 year into the future. And the only contract among those that has liquidity are the December expiry contracts. So in this case, currently I'm hedged using the December 2024 puts, but we are getting closer to the end of the year in October and November, I'll start using the hedges for December 2025 puts. So what I'm trying to highlight is uh, by the December 2025 expiry Nifty puts, which are about 10% of the current level of the market. So if the current index is at 26,200, so buying options exact 10% would be closer to 23,500. But since the put options are only liquid at 1,000 point intervals, either one can buy the 23,000 or the 24,000. So one has to buy the hedges at intervals of 1,000. So the cost of buying these hedges is low because the VIX range in India, in a bull market, VIX is typically down. In India, it's in the range of 12 and 15. Whether this actually effectively captures the risk, I would tend to say no. Uh, Largely because there are so many lakhs of players trading index options that and many of them are sellers, majority of them are sellers. So that by itself creates this pressure on the premiums to stay low. So 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 since the premiums are low, then it's a low cost opportunity for a low cost tool to kind of buy hedges. It's just like say historically the insurance of the premium for insuring your car for a year was say 15,000. Now because a new player has entered into the market, he's offering those the insurance for 10,000 rupees. Then obviously you are a gainer out of that. So why not use that? So what I'm trying to say is that currently with the IVs level so low, it's the cost of hedging is not so high. So so the cost of ensuring that broadly would be between 1 to 1.5%. I'll on the next slide I'll highlight it with an example. So since we are buying the hedges 10% below where the index is, so the drawdown or for the first 10% correction, you have no hedges. So you have to bear that pain. But post that, those hedges will kick in and they will help you limit the downside of your portfolio. So one can argue that uh, uh, the beta of the portfolio is not similar to that of Nifty. I totally agree. So one way to do that is I'm trying to move as the market keeps running up. I'm shifting my portfolio from small caps to large caps consciously, and I've been doing it over the last 18 months. Uh, and I continue to do so. I would say now maybe 70% of my portfolio is large caps, only 30% is small caps. And if the index keeps going up, the weightage will further skew in favor of large cap. Uh, so will I will continue this. So I started it last year. I've continued this year. I will again, as I said, I will buy the hedges for 2025, and I will end up. I will aim to buy hedges for 26, 27. I will. Point being is I will continue to do this till the point the correction comes in. And since the cost of hedging is only for part of the portfolio, the cost is not so high for me to kind of spend it. You buy insurance uh, like the other example is health insurance. Every year you are not falling sick means that you paid the premium for nothing. But that's not the point. The point is you were healthy, so it's a good outcome. So if my hedges don't come into play, that means that my portfolio is doing good. So I'm happy with that. I'm willing to pay the price for the hedges. And I will continue to keep these hedges continue till the time that big correction comes. When I say a big correction, it's of the order of 20% plus. When that kicks in, I would have made money in my hedges, and post that whatever money I make out on the hedges, then that is cash with lying with me, which I can use to buy new positions in stocks, uh, which could be deployed post that big correction.
Gaurav,
That
can you explain why the drawdown is limited to 10% correction in the index?
because we are buying the puts 10% away from where the index is. So the index is at 26,200, and if we end up buying 23,500 or 2,300, 23,000. So till the time the market corrects to those levels, there is no hedge.
Okay.
And I'm not saying it's only going to be a 10%. The correction could be higher also, and it's only on the portion of the portfolio that you are hedging. Now,
Right.
I'm not hedging the entire portfolio. What I'm saying is that currently the hedges are 30%, but as the index goes up, my hedges will go up to 40, 50, 60, 70, or even higher. It's a function of what the market keeps doing.
Right.
Sure. So we can move on to the next one. So this kind of highlights what I was trying to say. So say you have a portfolio of 1 crore. You want to hedge 30% of that, which is 30 lakhs. Index value is 26,260. Strike price I want to use for hedging is 23,000. 23,000 is 12% away rather than 10% away, but the choice is between 20,000 puts or 24,000 puts. So I chose 23,000. So the premium of that contract, which is a contract Nifty 2000 23,000 put contract expiring in December 24 at 25, is 405 rupees. I checked the prices just a day back. So when you say the total hedging value, so hedging value is basically the strike price, which is 23,000 into the number of contracts that are units I've bought, which is 125. So 23,000 into 125, which is 28,000, 75,000. So that is broadly 30%. So the total premium that I pay is number quantity into the price, which is 125 into 405, which is 50,625. So premium as a percentage of a total, which is the cost you're going to spend in buying this, is 0.5% of the total portfolio. So 50,600 is what percentage of 1 crore. And premium as a percentage of hedge portfolio. So a better indicator is percentage of the hedge folio. And because it's if we buy today, it's for 15-month period. So I put it on an annualized basis, it's 1.35%. So as per me, this is a pretty uh, cheap way to kind of buy insurance for your portfolio. So all I'm saying is that options can be used as a tool to insure your portfolio. So can we move on to the next one? Okay. So a report came out a few days back from SEBI, which kind of highlighted what issues that investors are facing. And so I just thought I'll take a few snapshots just to give an idea. So over the last 3 years, the retail investors has lost close to 75,000 crores. And these are all individual traders who are trying to make a fortune out of trading options. Some are doing part-time with their jobs. Some have actually quit their jobs and trying to make a mark out here. But the total aggregate amount over the last 3 years is 75,000. And that has made the regulator, SEBI, quite worried about what is happening out here. And the second chart highlights that if since it's a zero sum game, it's the individuals. So this highlights what happened in 2024 in the financial year 2024. So retail lost 41,500 crores, and that money was largely made by two category of people. One is the FPI; these are the hedge funds. You might have heard of the name of Jane Street, Citadel, or even the domestic, some of the Graviton. Uh, and then prop traders. What do you mean by prop traders? It's the brokers who are trading on their own books. And the tool that all of these guys have are algos. And typically these are high frequency algo trading. When you say high frequency algo trading, it means that in 1 second, an individual trader might be able to punch in one order uh, in a few seconds, not even 1 second. But in 1 second, these guys can put in trades, hundreds of trades for the same underlying security. So they can trade an order of magnitude faster than other people. And that's why even before people react, they tend to make money. And these people thrive with the volatility. So whatever the retail traders are losing, this is being made by these so-called prop traders and FPIs. So can we move to the next one? So again, now look at the data points. There are more than 1 crore retail traders who on an average have lost 1.8 lakhs. Who have on an aggregate lost 1.8 lakh crores between in the last 3 years. So prop traders and FPIs generated a profit of 61,000 crores, which is largely equal to the money lost by retail traders and a few HNI traders who are trading manually. So it's just simply a transfer of wealth from retail to these prop traders and FPIs. So one should just sit down and observe what is happening. On an average, a typical retail trader would have lost rupees 1.2 lakhs per year. 93% of the retail traders lose money. Of the 7% that make money, that have made money in the last 3 years, only 1% have made money more than 1 lakh rupees. Now, if you look at the larger picture, you have as a option trader, you have a 1% chance of making money over the next 3 years, which is maybe a material amount. So 1 lakh being, let's put a threshold of 1 lakh as a material amount. So you only have 1% chance of earning it. It's so what this implies, it's nothing more than trying to buy a lottery ticket. 1 in 100 is going to make money. So for every success stories, there are 99 others who have failed in trying to do what they set out to do. And the interesting part is that 75% of the people who have lost money over the last 3 years still continue to try their hand in options. So this points to the fact that option trading has become more closer to addictive behavior, just like gambling. So all these data points are making the regulator extremely worried about what is happening. So there are changes coming in. Some are announced. I read in a news article on Monday itself, a whole slew of announcements might come in. We can move on to the next one. So, what is driving this trading frenzy? So, currently, India, the option trading volumes are the highest in the world. By certain metrics, in terms of the number of contracts traded, the total number of contracts traded are more than 60% of the global traded volumes. So, India by its own has a 60% market share, which is humongous compared to the fact that not the majority of the population has exposure to the market, unlike the US or the other developed markets. And simply because of the fact that option is a complex derivative product, not many people understand what are the risks involved. So this chart again highlights what has happened. And this frenzy is largely driven by what is the volume being traded on the 0 day to expiry. So on that particular day, the option contract is going to expire. So on that day, you'll get to know whether you made money or lost money. And this potential thing of buying options, out of money options, and then hoping there is a big spike in the market. There are days when those low premiums one can make more than 100 times on that option. So people are buying those options in the hope that they can make money on those. But largely that never happens. So it's nothing but just like but buying. So the volumes which are the biggest chunk is the expiry day trading volume. So in the Sensex and BankX, it's more than 90%. In Nifty, which was recently again, I think not more than 2 years old, 88%. And Nifty and Bank Nifty, which are the most liquid, it's still 64%. So this is nothing but it's the option trading market has become a casino, and where tons and tons of people are trying to try this hand. I just put out a tweet that I came across yesterday of a person who's finally realized that he's lost money. This guy has lost more than 50 lakhs trading options over the last 3 years, to the point where he's totally lost his confidence, lost his family's fortune, and now trying to mark a new beginning. So it's a story of what is happening right now. Next slide, please. So, what are the key takeaways out of what I'm trying to highlight out here? One key point is everybody should understand their uncle point. I've talked about this earlier in the slide, but one should know what is the maximum pain point till which you are willing to lose money, and after that, you will start behaving irrationally. If you haven't experienced that, believe me, a time will always come, at least once in your lifetime, when you'll experience that. And in case you understand it early, then allocate your across assets accordingly, and you will then understand the value of hedging. So second point is, while some retail traders do make money, they are few and far between. So that realization has to be there. So retail F&O traders are nothing but fodder. They are the ones who are giving all the money to the proprietary traders and the foreign hedge funds. So there was this news article that Jane Street uh, hedge fund in the US sued two derivative traders of theirs who had quit and moved to another fund, saying that they are taking proprietary trading strategies largely on the Indian option markets. And since it was filed in a court, some of the allegations became public, and they alleged that that strategy made them more than $1 billion in FY23, in calendar year 23. So that's the crazy kind of money these funds are making. But since it's a zero sum game, who are giving them the money? It's the retail option trader. So the other point I want to highlight is it's this is the world of social media. Everybody comes across stories of how people are managing 50, 100, 200, 500 crores of money and trading so big in options. So, or people who have made hundreds of crores, or if not hundred, tens of crores trading options. One should understand that the context could be very different. Uh, I would take all those stories with a pinch of salt, how much they are making and how much, what are the quantum of those money they are making. For many, it's just a tool to kind of promote themselves and try to make money uh, out of doing workshops, webinars, and mentorships. So, and the other point is that the circumstances could be very different. Like I, I also trade options, but I've gone through the journey over the last 15 years, and I have learned many things not to do. Rather than what to do, I have learned many things not to do. So I do feel that talking about what I do in options, it doesn't make sense because the context is very difficult, and what we do is not easy to understand. It You require experience to kind of manage things. Uh, just to give you a point, like covered calls, uh, uh, there are times when on our individual stocks we lose huge amount of money. So if people don't have that temperament to handle that and how we handle those drawdowns, it doesn't make sense for them to even think about getting into it. The other side is we try to diversify our risk by doing covered calls on more than 20 stocks. Now, given the size of the lots, contract lots, the portfolio that is required to do this is becoming bigger and bigger. And if the lot size is further increased, the portfolio sizes have to further increase. So the circumstances and the context are very different. For somebody to say that I'll just try to replicate what the other person is doing, it doesn't make sense. One has to go through the journey and be absolutely committed and driven and understand the risks in order to be successful, because the success rates are very, very low in this. Uh, what I wanted to highlight is how I'm using options as a hedging tool for my portfolio. I think it gives me a lot of comfort to sleep at night, even if tomorrow the market becomes volatile and corrects in a big way. And there could be multiple reasons. You really can't forecast what's going to be there. But if the correction comes, I know that I'm okay with what will happen. So so I firmly believe that the stock market is a pendulum. Highs are followed by the lows. A bull market is followed by a bear market, followed by a bull market. That's the cycle that follows. Currently, we are in a roaring bull market. When it will end, I don't know. But I do know at some point it will. And similarly, currently, greed is driving the market. Everybody is feeling FOMO, the fear of missing out, and they want to participate in whatever is coming their way. But it can quickly turn into fear. I've seen it many times in the past, and there's no reason to believe that that will not get it. So I'm cautious on the market. So, and to borrow the words that you use, Ankit, don't predict, but prepare for what is could potentially come in the future. So that's it. Thank you guys, uh, and we'll open it up for Q&A.
Thank you so much, Gauravji. As you rightly said that on the social media and specifically on YouTube and Twitter, we see a lot of people claiming to make a lot of money or wealth through option trading. And I completely agree with you where most of the time what they are trying to do is they are trying to catch eyeballs, sell their webinars or sell their internship or whatever they have. But uh, the numbers which SEBI has shared talks about the basically what is the reality. And it is good that you shared the dark side also as to what can go wrong. And I'll just reiterate what you have just said is that it is something which needs a lot of experience, it needs a lot of capital, it needs a lot of patience to understand because I'm sure, and we'll cover those in our Q&A now as to what all needs to be taken care of before you jump in this field, right? So I see a lot of questions on the chat box also. So I'll try to quickly run through my questions first, uh, and then we'll see depending upon what time we have, and we'll take the questions from the audience as well. Okay. So Gaurav, my first question is that just like you evolved as an investor over time, I'm sure you also evolved as a trader in options also, as as you have been doing this for over a decade now. Would you like to share some things you have changed over time and what still remains the same as it was when you started trading in option?
So I guess so again the context of when I started trading options, I had gone through a big pain point, and I thought I'll act intelligently and accordingly do that. But again, made the novice mistakes of selling. I used to sell 15-20% out of money call options. Why call over put? That I in fundamentally understood at that point also. I would always want, as an investor, I always have a portfolio. Okay. So that portfolio, I wanted to go up, but that's not entirely in my hand. So, so what I do is if I sell calls which are naked, when you say naked calls is basically no underlying future or any other contract to kind of hedge them. So when I'm selling naked calls, what I'm making a statement is that I'm okay with those calls ending up in a loss, simply because in case those calls end up in a being in a loss, that means my portfolio has gone up. So my portfolio acts as a natural hedge to selling the naked options. Whereas if I sell naked puts, and if the market corrects sharply, then I'm losing money on my portfolio and I'm losing money on the options also. So my thing has always been to sell calls rather than puts, and because I'm an investor, there is a natural hedge of selling calls versus selling. So that's one thing. So when I started in 2009, I thought that selling naked calls is an easy way to go, and I would typically sell them 15-20% away, assuming saying that in a year or in a month, stock prices will not go up 15%, especially for the large caps, because these option contracts are in larger cap stocks, not on the smaller cap stocks. So, so that was the premise. It worked out well for the first 6 months, but I had no idea about what an event can do. The general elections were there, and I checked that data for the past 2, 3 elections, and the market moves were not so dramatic. And once in 2004, the move was there, but on the downside. So if I'm selling calls, downside really doesn't impact me. So I thought market can move sharply on the downside, but not on the upside. But then May 2009 happened. The election results were hugely positive for the markets, and the index opened gap up on Monday. This the weekend the results are coming out, and while others are saying that it's a good outcome for the country, what I'm thinking about is I'm screwed. So that's so the other lesson I learned at that point of time, I lost big money. In fact, the entire upside that came in that rally for my portfolio, I effectively lost similar amount of money on the calls, naked calls I had sold. So that kind of just took away the upside that had kicked in. So that's an important lesson. The other lesson that I learned was that don't trade in options before big events. So just like the general election outcome was there in June this year again, and this time I had simply bought hedges. I was a buyer of option, not seller of option. So that's one context I learned before the big events. Don't trade on options. Uh, Also, I think the other important aspect of see, I'm largely a seller of options. This hedges I'm buying for the portfolio, but otherwise in covered calls or any other strategy, I typically sell options. Now, what that means is that I'm acting as the insurance companies and ready to take the downside of if any accident happens. Now, so that is an inherent risk. I'm taking risk on. I'm what I'm allowing to do is the buyers taking risk from the plate of the buyers of options and into my plate, which is just adding to my risk. Now, so think tend to think of yourself as the insurance companies. One way is that you collect the maximum premium, and the way to collect the maximum premium is keep on selling policies no matter what the premium is. Okay, but what you don't realize is that as the premium keeps going down, you're taking more and more risk on your plate. And when the accident comes, the losses are going to be that much higher. So, so the way to prudently do it is when I started out trading options and seeing the premiums, I had expectations that I could make uh, maybe 3% a month, 4% a month, as some of the other people's claim to do. That I would do that, and because of that, I was very aggressive in selling options. Uh, Over a period of time, I've realized that it's a fool's game. You earn for 5 months and you lose everything in the 6 months. So what my aim now is to whatever option trading I do is the idea is to make between 12 to 24% a year. So lowering the expectations by itself reduces the risk that you are end up taking on the way you trade options. I'm not talking about the various strategies that are out there, but broadly, that's the way to reduce the risk that you're taking. Uh, and The other thing is options allow you to take leverage. You can always, because the margin that is used blocked while selling an option is low, you can take much higher exposures. I've learned it the hard way that I don't take leverage. So if I have say money, 1 crore lying in the bank, I will only take exposures for 1 crore. I don't even take exposures for 1 crore 10 lakh or 1 crore 50 lakh. I don't use options to lever my portfolio in any. So those are the few lessons I've learned that has helped me. The other thing is that I trade options in a way that while my upsides may not be so dramatic as some of the other people refer to. But I do it in a way that I'm trying in no given year, financial year, I should have a loss in my option portfolio. So when I say I don't want to have losses, there is a cost of buying all kind of hedges across that portfolio. So I tend to do that. So So I've lowered my expectations, done my trading in a way that I don't end up losing. As long as the drawdowns are there, whatever returns I make, I treat it as a bonus.
Got it. That is very helpful. So you have spoken about instances where things didn't go as per your plan. But do you have any other experience also? I'm sure that you must be having where things worked fantastically well for you and you made a killing, but probably it didn't occur in- as frequently as you would have liked.
So, Ankit, talking about a trade that made lots of money doesn't make sense. You have to talk about the larger picture. Say, if I have a 2% allocation in a trade and I make 100% in that, that's on a portfolio level, that's still a 2%. So individual ideas, referring to them and seeing that picture that anytime you capture, again, you're trying to propagate the fact that one can take tons of money. So because we follow a portfolio approach, what is happening in an individual stock or a trade is uh, is uh, is kind of propagating a fallacy. Just to give a case in point, I started trading options in GMR Infra, which now is GMR Airports. And 2013, all those old infrastructure companies uh, kind of were falling by the wayside because they had huge debt on their balance sheets. They had banks were facing NPAs and they were cracking down on them. NCLT had come into was getting into the picture, and many of those old infra companies were falling by the wayside. So in GMR, what I saw was intent on part of the promoters to actually try to not to default on their debt. They again had participated in huge assets in power, in roads, and airports was the third vertical they had. But they had huge debt on the roads and the power vertical. They had gas waivers, power plants, and there was shortage of gas, and those plants got shut. Two of those plants. So they were in big trouble. But the call I did made was that while they were reporting huge losses, the intent of the promoter was good, and my take was they will avoid bankruptcy. So that was the broad thesis, and the other advantage I had is on that stock options were there, and the premiums were pretty high. In fact, one of the highest across all the universe of. So that was the added incentive I had. I've traded covered calls since 2013 in GMR, and today GMR trades at $95. There have been many ups and downs. When I started out, was GMR was trading at 13, $14. There have been many highs and downs. But the interesting aspect is, after all the ups and downs, I got the gain that I did from 14 rupees to 95 rupees, which is there currently. But simultaneously, I may have made more money by selling options on it than the actual stock. So those are those journeys. But for every GMR, you have also a company like JP Associates, where they did a QIP at $80, and I thought after the QIP that is the anchor price, and I started selling puts on it at $70. The stocks kept correcting, and it gradually went down to as low as $7-8, and there was more than 90% drawdown in the stock, and I kept at it. So after I think 7 years of trading, I finally used to track my trades individually on a stock, and after finally 7 years of lot of pain and trading, I finally broke even on that. So and that's when I exited the stock. So while I'm happy that I didn't lose money on that particular stock, but it took so much of my time and horsepower just trying to manage that trade. But I got a satisfaction I didn't lose money.
Right, right. No, that you made a very important point, which is a big learning for all of us, is that uh, uh, individual trade doesn't matter. Ultimately, what matters is your portfolio performance over long term. Even the portfolio performance for a year or two doesn't matter in that way, right? So,
Yeah,
so
yeah. So that's a very important lesson for people to learn, because in the social media out there, even among your friends, the discussion is the stock I made the money on. But the bigger question you have to ask them is that what yours was your allocation on that particular stock, and how much of your net worth you are invested in the stock market. So if your net worth is 100, you are invested 10 rupees in the stock market, and out of that 10%, that stock idea is 0.5%. And if you it's doubled in 3 years, the impact on your net worth is
minuscule,
0.5% over a 3 month period. So what's the idea of talking about those ideas?
right? Right. No, so I'll move on to the next question, Gauravji. So in June 2024 news article, I read that the notional value of options of India's Nifty 50 index has averaged about $1.64 trillion a day, and it surpassed the average daily volumes of S&P 500 index, which is a much more older index. And I think its value was about $1.44 trillion dollars. So what do you make of this data point? Does this scare
So
you? Do you
again,
expect?
matlab, this highlights to the current frenzy in the market, but I think it's a misnomer the way this calculation is done. When you say 1 trillion of that value, see the notional value of the underlying, which is Nifty. As the Nifty index keeps going up, the notional value any which ways. If I'm trading 100 lots on Nifty when the Nifty is at 10,000,
Mhm.
okay, so suppose 100 quantity I'm trading on Nifty, which is at 10,000, I'm trading 10 lakhs. Okay, so basically the underlying into 100, it's 10 lakhs, and now Nifty is at 26,000 into 100 quantity. It's going to be 26
26
lakhs.
lakhs.
So I'm doing the same thing, but the notional value has gone up 2.5 times. So the other thing is, when say on a say I'm selling a on a 26,500, I'm selling a 2 rupees call. What I'm फोकस्ड ऑन इज कि वो 2 रुपए 8 रुपए हो जाएगा, 10 रुपए हो जाएगा, मेरा लॉस क्या है, वो 100 रुपए हो जाएगा, तो मैं 100 रुपए लूज करूंगा। मैं कोई वो 26,000 रुपए नहीं लूज कर रहा।
Exactly.
So it's a very big misnomer. Many media articles cover the notional values while talking about stocks. Notional values don't mean much. It's the premium that should be talked about, not the notional values. Because if tomorrow the Nifty goes to say 50,000 or 1 lakh, say a decade from now or 15 years from now, then you will say that again, now you're trading $10 trillion a day. So those notional values don't make it's the premium. How much of premium is being traded? That's I think a much closer metric to how things should be measured. One. Having said that, doesn't take away from the frenzy that is happening in the options out here. And as I pointed out, that more than 60 the global option traded volume seems to be happening out of India. And even among that, uh, 80% of the volume is simply coming out of now look at the index. 90%, 95% of the volumes being traded are index stock options. Okay. Now, out of those 95%, close to 80% are being traded on the day of expiry for those indices. Okay, so that's the other data point. And then out of that 80% that is being traded on the last day, the more than 50% is getting traded in the last half an hour, which is the 3 to 3:30. So it's this phenomena of the trading of options expiring on every given day, and the options and the phenomena between 3 and 3:30. Because why 3 and 3:30 it happens a lot is because at 3:30 everything will go zero. Either the option is in the money, out of money, one of the two is going to happen, and all the time premium goes to zero. So ऑप्शन बायर्स आर ट्राइंग टू बाय द लॉटरी की वो 3 से 3.5 के अंदर वो 200-300 पॉइंट का स्पाइक आ जाए तो हमारी लॉटरी लग जाएगी। और ऑप्शन सेलर्स ये बोल रहे हैं कि वो स्पाइक आएगा नहीं, तो हम ये पैसे कमा लेंगे, फ्री का पैसा। तो ये हो रहा है, but and this is what has got and in this a sudden movement in stocks is creating spikes where the option sellers panic. 1 रुपए की चीज जो बेची हुई है वो फिर 100-200 रुपए में भी जाके बिकती है जाके. So these spikes are artificially being created by these high frequency algos. Now, given the kind of money that is being made, a lot of money power has gone into it, and uh, there are traders in India, outside India, which have the money, the technology, and the experience to create these spikes and benefit out of it. As I said, in a second, an option trader, in a couple of seconds, he might be able to punch an order. In that 200 seconds, they are talking about reaction times of microseconds. In those 2 seconds, they could punch in 1,000 orders. So you won't even understand. आपको screen पे भी नहीं दिखेगा कि क्या हो गया और वहाँ पे they have made their money.
Right, right. So good that you brought about the point of technology and algos. So my next question is related to that only. So where do you see the future of option trading, say 5, 10, 20 years from now? I mean, I know it's very difficult to gauge so far into the future, but and we have already discussed, don't predict, prepare. But I'm just asking more from the perspective of tech and algos.
So
From
yeah,
what yeah.
so this is the other interest of mine, thinking about where AI is headed. Till date, AI was very narrow in terms of it focused on a particular stream. So if a AI is trained on, say, playing chess, then they're trying to get better and better, and over time they defeated the best players out here. Similarly, there's another board game like backgammon or Go, they but now what is happening is the compute power is allowing them to gain breadth. So it's not just so, and as that breadth, it's not just about one set. They could be good at multiple sets. And this entire capturing of the world knowledge through these large language models. So anything that is, this is building a breadth, and computing power is going up exponentially. And the new set of AI chips, which kind of made NVIDIA what it is, all of that is adding up to become a force to comply with that. There is recently a documentary on Netflix, which is hosted by Bill Gates, and he's talking about his vision of what is happening through AI, and what other people who are fearful what AI can do. So the doomsday scenario is what we talk about in the Terminator series of movies, where AI gains conscious and sees it as a different species, and as a species they want to dominate the world, and if humans come in the way, they'll wipe them out. So that's kind of the scenarios that are going. So the things are so rapidly changing. The so another case in point, I have a friend in Google who he works in Google in these large language models. What he's trying to he highlighted to me that while they are building these models, they can't really understand how they are learning to do the things they are learning to do. So typically for a coder, it was always this key, matlab, you're building an algorithm, so you can always justify the outcome basis on how the algorithm ran through the process. Now, what they are saying is that we really don't understand what connections got made and how they were able to infer this out of that. So people have the coders themselves are losing that ability to see what is happening. So how this will evolve, nobody knows. One. So whether how this is going to impact, whether so that's a larger question, whether humans with all their so while our ability to retain things is very low, but what we thrive in is being jack of all trades. We know a bit about everything. So, but this bit about everything, they could be computers of 10 years, 20, 30 years into the future where they know everything about everything. So once those came in, then if the stock markets are going to function the way they are currently, that itself is a question. So there's no point trying to make predictions that much into the future. Change is coming; it's getting accelerated. Whether there'll be regulations, whether we can control it, too early to say. But again, that's the fact of life and human evolution. Change kicks in. But with AI, some intelligent people are feeling that we have opened up a Pandora's box, and we might not be able to control what the outcomes are. So while AI in India, the question or in US, where all these innovations happened to start with, there is this question of ethics being decided or the future of humanity being decided. But then other countries are equally getting ahead of them. A country like China, Russia, they are not driven by the morality questions or the greater good. Uh, the society in China is absolute nationalistic, and they want to be the number one in the world, and they'll do whatever it takes. So whether they are able to unleash things that others haven't even thought about. So there's a big question mark about the existence of the human race, about where things will look like, not into the distant future, but in the coming decades. So I try not to make any kind of predictions into the future. I'm just trying to think 1 year at a time. But I absolutely don't want to make predictions around what's going to
Yeah, if we listen to what someone like Elon Musk and maybe Yuval Noah Harari, I think he has come out with a new book which focuses on the dangers of AI. Then we'd kind of think that what is the purpose of having a webinar like this? Because
Yeah,
everything is
see, the ultimate truth is death. So if you're going to die within a certain time frame, so why are you even talking to anybody else if you're going to be ended
right,
up back to? So that's not the point. You have a limited journey, and you do what you have to do to move ahead, and
right.
you do it in a way that you're gainfully occupied. So those are the larger questions. That's not to interfere with your daily to dos in life.
Right. So I see a lot of questions on the chat box. So I'll put a pause on my questions because then we'll not be able to cover. And I'm seeing a lot of questions which you have already answered through your presentations, either directly or indirectly. So I'll unfortunately skip those. So there's one question which is a very specific question from our team only, Shivam. He asks, we are at a stage where everyone is fearing a crash or a correction. Market probably is just waiting for an event. Should going for in the money Nifty put option a good low risk strategy at this stage? And the second question, which is related to this, is what if the portfolio is mainly small cap and micro cap skewed? Is buying Nifty put a valid strategy for that kind of a portfolio?
So
I
I'll
think
go to the last question. Then, if the portfolio is entirely SME focused, then God help you, nobody can.
no,
So
it is not SME
that's my
focused.
view.
Yeah, it
That's
is
my
not
view.
SME focused. He's saying small cap and micro cap focused. Hmm.
Yeah. Again, Nifty is not an effective hedge against small and micro caps. So as I said that what I'm trying to do is whenever I sell a small cap stock, I'm buying the larger caps rather than the smaller caps. So that's because the hedging tools, we have a mid cap index which also has options, but they are not long dated. Buying hedges which are a week or month into the future means that you're predicting a correction in the next week or month. Nobody can do that. If they were decade long hedges, I would have gone out and bought those. But the longest I can find are 1 year ahead or 15 months ahead. That's the longest I can get in the Indian context. So in US, there are tools, but unfortunately, I'm not in US. So one has to live with what one has. So if the portfolio is SME focused, then small cap focused, that the way to build hedges is only through gradually shifting the portfolio to large caps. And it goes back to the ratio. The ratio of SME to Nifty, which is large cap, is so skewed that you have to understand the risk reward that you're playing with in your mind. So that is one. Second is all people feel there is a correction. That is absolutely not the case. It's the older veterans who feel there could be a correction coming. As I said, post-COVID, there is a whole plethora of people who talk about the bountiful future that lies ahead. So that breed is a different breed, and that the collective force of that breed is what is pushing up the market. So let's not say that everybody thinks that way. It's the brutalized old guys who think it that way.
And
The final question, I think part of the question, which was to buy the in the money put options on Nifty. So that's going to be extremely costly. And in case the corrections don't come and you lose money on those options, you might do it once, but after that you lose your appetite to do it again. So one has to be conscious in what is the cost of buying those insurance. You can't be paying 10% premium just to buy. If tomorrow you buy a car for say 10 lakhs and the insurance companies ask, I will charge you a premium of 2 lakhs, how many people will pay? So insurance premium has to be in a way that it is digestible, at least in my terms. So that's why I'm conscious. Why do I buy my hedges 10% away? Is because largely because I want to reduce the cost I'm paying to buy them. If I have to continue like this for 5 years, because who knows, 5 years from now, the market is still going up 1 year after the next. If something that hasn't happened in the past doesn't mean it will not happen in the future. So what I'm saying is I just can't predict. But this is a low cost strategy for me to hedge my portfolio. So when I say 10% away, in my mind, I'm saying that I'm not exposed to those 30-40% corrections that might kick in, which kick in once in a while. And that is what brutalized me in 2008, which could potentially had hit me in March 2020. But since I had learned some lessons in March 2020, so I was much better prepared. Uh, March 2020 was not that painful at all for me. So I think I learned my lessons. Uh, but having learned what I've learned is that I'm willing to take part of the downside, but only up to a point.
got it, got it. So I'm reminded of two things. So I have two follow up on this. One is that it reminds me of what Taleb says, that don't tell me what you think about the market, show me your portfolio. So like when people say that market is overvalued or market will crash, many people say that just for the discussion sake. But most portfolios are probably not positioned thinking about a crash or preparing for a crash. Right. So that is one. And the second thing was, this was interesting when you were mentioning about if there would be decade long hedges. I don't understand. Why would you buy decade long hedges from, as in, what makes you make that kind of a call?
Okay, so decade long hedges is, suppose hypothetically I'm able to buy a 23,000 decade long hedge. Now, what I'm saying is that now I have a floor to my portfolio. I'm fully invested. See,
Mhm.
now I have a floor to my portfolio, and that is 10% away. So now any correction, so my floor now is effectively 23,000, not zero. So,
Okay.
assuming ki 100% of my portfolio is hedged.
Got it.
And say 2 years from now, the index is now say 30,000 or 35,000. Then if I have a decade long, then I won't stay at 23,000. Now, then my hedges would have moved up to 30,000.
Right.
So I'll keep rolling up my hedges because I don't want to stay too much far away from the market.
Right. 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 Right.
Okay, I can move from one strike to the other because I want to, my hedges should be about 10% away from the market.
Hmm. Right. And
Uh,
you
does
can
that
take.
answer your query
Yeah,
around
yeah,
what
yeah.
I'm trying to?
Now so there was a conceptual misunderstanding in my mind, which got clarified now. So does that mean in US market we can have those kind of long hedges? That is what you meant when you were saying earlier?
Yeah, I know that stocks have options 2-3 years into the future. Whether it's a decade long, I don't know. But Buffett in 2008 did OTC contracts where he sold puts going out 10 years into the future. I think 2020 he sold those puts, and he got billions of dollars as premiums. So he undersold. He did not do it on Nasdaq, but he did it on Dow Jones, S&P, and I think FTSE.
So at one stage, at one side, Buffett teaches us that futures and options are mass destruction, weapons of mass destruction, and on the other side, he does it himself.
This point is again coming to and to the point. Leave it to the people who understand what they're doing.
Right,
Let not the retail come in into the picture. Matlab, there are many complex, like the way they underwrite their insurance. They are taking derivative contracts. They are also giving insurance. They are the biggest, by far the biggest reinsurance players in the world.
right,
So they write insurance. That's what they do. So here again, they did the insurance. But what I'm saying is, he took a call for 10 years,
right, right,
just like his investing. He's not trading for every day expiry.
right, right. So this this point which you mentioned, as in brings me to this question by Chandramouli. He asked that, uh, are there products out there in the market that does the hedging for us? As in many retail investors, as you rightly said, are not equipped for these kind of trades, or but can they park money with these kind of people or products where these kind of hedging is being done in a professional manner and with a track record of, like in your case, I know that you don't manage other people's money, you manage your own book only, right? But do we have other people who are doing it professionally, or would you recommend? I'm not talking about recommending a particular person, but recommend retail as a community to park some money there.
So yeah, matlab, there are no effectively such products which are in the regulated market that are out there. Maybe uh, SEBI is coming out with a new set of criteria for mutual funds, and it's allowing them to launch certain kind of products with that. My take is some of those products will incorporate such strategy, but
Okay.
I can't think of anything that could potentially offer a product that is for the retail. There are certain family offices that are deploying such strategies, but these strategies, if there is a dedicated person being doing it, the pool of money has to be big enough to justify dedicated people running it. And like tomorrow, a set of people who understand all this, they can't go out and offer these services to the retail because SEBI doesn't allow it.
Right.
So,
No,
so
if SEBI allows it, let's take a hypothetical scenario where SEBI allows this kind of service. What will be your take in that case?
yes, if they're able to highlight what they're going to do, Taleb runs a hedge funds, which is just buying the tail risk. So
I,
he
I
does that.
was I was about to ask you that question. So why don't you just expand a little bit on that as to what Talib does in that, just that strategy of option strategy, and how he benefited during that 2008 crash. You must be very well.
There is no literature around what happened in 2008, but March 2020, there is a bit of things what happened.
Mhm.
So when you are saying tail risk, the what the that hedge fund does is, say the index is currently at 26,000. So what they're saying is that we will buy deep out of money puts. So which could be, I'm talking about 10%. They could be talking about buying puts which are 20, 25, 30% away. So why they are buying it? Because the premium to be paid, like on a 10% out of money put, I'm paying 405. But say which something that is 300% away could be only $50. 30% away could only be $50. So suppose uh, on a 26,000 index, they are buying the 20,000 puts on an annual basis. They're just spending say 50, 70 rupees on that. So effectively what they're spending, not 50, 70, I think that's too low a number, maybe 150, 200. So effectively what they're doing is they're spending 1% a year on buying those hedges, assuming they're buying those annual hedges. And suppose tomorrow something like March 2020 happened where the index during the month corrected close to 40%. So from 26,000, if it's correcting by 40%, which is a 10,000 points correction, it goes to 16,000. So if they bought say something at 150, those 20,000 votes, those 150 will grow into 4,000. So that is a 25x payoff. And simply if they rather than buying the yearly puts, if they have they're buying the monthly puts, so and doing it every month. Now what is happening is the monthly put will not even be 10 rupees for a 20,000 put. So when the month happens, they're spending 10 rupees and they end up making 4,000 on that. So it's a 400x return. Point is being is that that will happen few and far between, maybe once a decade. So for the rest of the 120 months, they have to lose that 10 rupees every month.
If I have this correct, I think Taleb on that strategy had was losing for 10 years, and then in COVID one particular month in March 2020, he made a killing.
Yeah, yeah. So it's death by a thousand cuts. हर महीने थोड़ी थोड़ी पेन लो ताकि फाइनली जब और मर रहे होंगे तो आप जिंदा हो जाओगे.
Right. So I don't know, Gaurav, how much time do you have? Because there are a lot of questions. Uh,
So we can continue for it's I think 1 o'clock now. So 2 hours, maybe half an hour is fine. If
okay, great.
outer limit is 1:30, we call it off. And if we run out of questions before that, we'll call it off earlier.
I'm sure we'll not run out of question because there are many. So I'll just go to the next one. So this is a very good question in a way. So he's saying, who are these option sellers?
People
How
like
do
me.
we know that the option will be respected? So I know this is a very simple and basic question, but there are people in the audience who will probably watch the recording also.
Sure.
Uh, I think for the benefit of them, if you can just expand on that. Uh,
So yeah, first of all, option trading is not a contract between say Ankit and Gaurav.
mm,
So it's not like Gaurav sold a contract to Ankit. There is an exchange in between. Okay. So the exchange provides anonymity. So when Gaurav sells, he doesn't know who has bought. It could be Ankit, it could be anybody else. Similarly, when Ankit buys, he doesn't know who sells. It could be Gaurav or it could be XYZ. So exchange is the one which is being the intermediary. It charges for being an intermediary and it ensures the settlement of the trade. So it's not like Gaurav sold and now he's losing money, and then he says that I don't want this contract, I made a mistake. So this can happen when you're buying a property, the buyer and seller, because the agreement is between the two of them. The seller can say that नहीं, अपना बयाना वापस लो, मुझे नहीं चाहिए. And it happens once in a while. But when you're doing it on the exchange, it's the exchange that guarantees the settlement of one. So the risk is simply speaking not there. Why? One exchange has a lot of settlement guarantee funds that are there, which are there to take care of such eventuality. Second is the seller doesn't default on his commitments. In order to sell that option, he has to give a certain margin money to the broker, who in turn has to give it out to the clearinghouse. So all that money is lying. So as soon as I say ki I'm not going to settle that account, that takes away from the entire edifice of exchange trading mechanism. So they try to take at least that margin that even in the 99% of the worst case scenarios, that margin is more than adequate to take care of whatever I have to pay. And suppose the contract is live and part of that margin it's already lost out, the exchange will immediately ask for more margin. And if I'm not able to give that money, the broker will cut my position. So one doesn't have to wait till the end of the contract. My position will be cut out. So I will be forced to buy, and at those high prices, somebody else chooses to sell. So who's willing to so there is absolutely, I think, 0% risk of somebody defaulting on that. I think the exchange mechanisms in India are one of the most robust that are out there in the world. So in my mind, that's not even a thing, a risk to think about. So.
Thank you so much, Gaurav. So I know this was a very simple point, but there are a few newcomers who still don't understand and get this. So thank you
So,
so much.
Ankit, maybe one of the questions, if somebody is asked, posted out here, and they want to understand the hedging strategies, and if they have questions around that, the hedging strategies that I talked about with the 23,000 ports, and if
Mhm.
some of the concepts they're not understanding, maybe you can unmute them, let them ask from their perspective, because
Yeah.
that's one actionable thing that I'm trying to highlight, and I want to make sure that everybody understands. So
Yeah.
I understand it because I do it, but if a layman should also understand, that's what I'm trying to say.
So like the example which you shared, on that example, only one of the attendees, Chandramouli, asked, in this example, if Nifty falls to 21,000,
Yeah.
how much will your hedge gain?
So 23,000 put will become in the money by 21,000 minus 23,000, 23,000 minus 21,000, 2,000 in the money. So for every contract, I'm going to make 2,000. So 2,000 into 125, which is the lot. So that effectively becomes 2.5 lakhs.
Right. And I think, what was the premium you paid for this?
I paid 56,000.
Yeah,
So it's 4x. See, the point is not for me to try to make money on this. There are two aspects around it.
exactly.
One aspect is around the fact it saves me from a much bigger correction. So I'm not worried about a 21,000 point correction. I'm more worried about if the corrections are of the order of 30-40%. That's what I'm trying to build a hedge for. So, so 12, 15 point correction, I'm okay with handling those kind of drawdowns at my portfolio. That
Right.
is one. And I'm not willing to take corrections beyond that because I feel that the market is overvalued. And I've shared metrics around why I feel so. Uh, if the market, say, finally corrects to, say, 18,000 or 17,000, then the market overvaluation will disappear. I will no longer have a need to hedge. So
Exactly.
I will take away my hedges. I will take my profits on that 23,000 hedge and use that money to reinvest into the market and no longer have any hedges.
That's a very important point which you made. So I hope this is clear to everyone who is listening now, or maybe probably. So it is not that when the market goes down, so essentially Gaurav ji is an investor. See, he will use that opportunity to invest, go long in the market rather than again trying
Go
to.
long in the market with the money I have made on the hedges.
Exactly,
So
exactly.
I'm already invested, so I don't have incremental money,
Right.
but I will make profits on those hedges. I will book those profits and use that money to again invest into the market.
So that brings to the main point or the starting point which Gaurav made at the start of the presentation, which I again want to highlight, is that he's using hedges as a source of income, which helps him to further build capital and invest in the market for the long term, right?
No,
And reduce his
hedging is not
loss,
a source of income. Hedging is effectively something that helps me sleep
reduce
peacefully
the
at night.
drawdown. Uh-huh.
Sleep peacefully at night. I'm not even aiming to say that my hedges will make me money. I'm not looking at it from that angle or that lens. Hedges will never make me money. Up till now, I've been using hedges for the last 4 years. I've lost money on the hedges, but I'm fine with it. There are other strategies that help me make income, call being one of them. But I've been talking about covered calls in some of my other public interfaces also. But what I've realized is that even though people understand the concept, it's extremely difficult for them to follow it simply because there could be big drawdowns in that. In a week, in a month, drawdowns can kick in. But because there also we buy hedges as part of that portfolio. But over a year, what we are aiming to do is have a positive outcome. So The way we have built those covered calls, say that big correction that I'm talking about, which comes, which is a 30-40%, is what I'm worried about. If that kicks in, market will be down that 30-40%. But my covered call portfolio should still be positive, slightly positive, if not. So it's the hedges out there are again in such a way that I should not lose money.
Right, right, right.
So,
Got it.
so hedges is definitely not an income strategy. It's a strategy to just help me sleep peacefully at night.
But covered call strategy, which you're talking about right now, those help you generate.
So yeah, we have kind of fine-tuned it in a way that what we are comfortable with. But I can tell you that there's over a 15-year time period that we have spent. There are no standard rules around it. It's very, very discretionary.
Right,
And I can't even explain all the nuances, even if I want to. Because there's so much discretion involved. You have to experience it to kind of learn it. अब कोई बोले कि भैया आप इन्वेस्ट कैसे करते हो मैं समझा दूं, मैं सब कुछ समझाने की कोशिश करता रहूं, मैं अगले 1 साल तक भी समझाता रहूंगा, बट उसके बेसिस पे क्या आप मेरे जैसा पोर्टफोलियो बना पाओगे? स्टिल नो, इट कांट हैपन
right,
बिकॉज देयर इज ऑलवेज डिस्क्रिप्शन.
right,
एक ही तरह की इंफॉर्मेशन को आप कैसे इंटरप्रेट करोगे और मैं कैसे करूंगा, इट्स ऑलवेज गोइंग टू बी डिफरेंट.
right, right, right. So I think one of the participant has raised his hand. So I'm asking him to unmute and
Sure.
so you can, Mr. MG Ramachandran, you can probably unmute yourself and uh, ask a question.
Thanks, Ankit. Very insightful session, I would say. Uh, Two questions in my mind. Are you using both covered call as well as put at the same time? This is one. Because if there is a forward movement, then we lose money on the both account. Or that's one. Second, you said that you are taking a 10% correction. Is it also possible because options, to my limited understanding, over the period of time it loses money? Can I also do in a similar way for a lesser duration with a lesser drawdown, probably 5% for 6 months or something like that? Or even a shorter duration for even a 1 month based on that, what is the correction I am expecting, 2%, something like that. Is it also possible? And what is the kind of strategy you adopt? Like today you are taking 15 months. When do you square off and move up to the 2026? Thanks. Yeah.
Yeah. So thanks for your question, Ramachandran. So I'll answer your second part of the question first. So there is a basic rule in options. Try to sell short-dated options and try to buy the long-dated ones. So the premium in the long-dated ones uh, on totality will always be lesser than the short-dated ones. Why I say so? Uh, because long dated ones, because it's a one-time transaction, and the total premium that is captured in it is usually lower than uh, the short-dated ones. Also, on the short-dated ones, if you are buying, say, the hedges for a month, suppose I'll give you an example. Suppose the index is at 26,500. You wanted to buy a 5% away option, which is 1,300 points away. Let's say the 25,001 put monthly on a monthly basis. You bought. Now, suppose the correction kicks in, but it doesn't happen in a single shot, and the correction is say of 1,000 points. So now you are at 25,200. You're still the hedges at 25,000 which you had bought were not effective, but they expire at the end of the month, they go to zero. So now, if you want to still keep buying the hedges at 25,000, now you have to basically pay a much higher premium than what you paid earlier. So if you choose to stay at 25,000, the premium is going to be much higher. Or if you say that again, I'll sell 5% below, then effectively your hedge is not at 23,000, then it's at 22,000. So as the market corrects on a rolling basis, you'll keep on moving away and away your hedges. Whereas if I bought the yearly put, then a monthly correction of 1,000 points, I'm still my hedges lie at 23,000. The premium may have gone up to double or triple of what it was. But my hedges lies, I'm not aiming to make money on those hedges. Those hedges are there for the year to kind of ensure my portfolio. I'm not aiming to make profit on those hedges. That's absolutely not the goal. So does that answer that part of your question?
Yeah, I hope,
Yeah.
Ramachandran.
So that's one. The other part which you said is that if we are buying hedges for the covered call portfolio, yes, we do buy hedges. In fact, that thought process for my equity portfolio came from this process of buying the hedges for my covered call only. As I said, if the market corrects big time, even if my covered calls, I don't aim to make a loss. Uh, so we started with that thought process, and then the thought came in: if the market is getting more and more expensive, why not use that also to hedge my uh, portfolio? So I started. I'm currently 30% of my portfolio is hedged, but next year I'm aiming to move that hedging to about 40, between 40 to 50%, because the market for the last 1 year again has gone up. So as the market further goes up, in my mind, the overall market is getting more and more expensive, and I want to buy more hedges. So that's the thing is, and on covered calls, as we have bought the hedges, and if the market goes up, see what is a covered call? We have bought the underlying. It could be a share. So So if the market is going up, that share also goes up. So we make money on that covered call. We might be losing money on the option that we have sold on top of that covered call. But in aggregate, we make more money in that underlying than we lose in the option. So does that answer your question?
Yeah. So what you are saying is the covered call, when you are losing in the options, you gain in the shares. But is that the entire share lot will be supported by the covered call, or will it be a percentage of the portfolio?
See, those shares that we have bought simply for the covered call portfolio. So matlab, the number of options we have sold may be more than 1x of what those futures and or the underlying shares or the futures that we have bought. But but it's not too much more. It could be more about 1.25x. It could be 1.5x, but not materially higher. And we sell out of money calls. We are not selling it at the money calls or in the money calls. So before those calls come at risk, the gains of the future is entirely ours.
Right. Right. And the last part was a rollover. How do you decide to liquidate the December 25 and go to December 26?
So the rule is pretty simple. Currently, my hedges are. I started the year with hedges of 21,000. As the market kept going up, my hedges have moved from 21,000 to 22,000. Now, as I roll into the next year, which is December 2025, I aim to buy the hedges at 23,000, assuming in October or November the market stays above 26,000. If it corrects, then I may choose not to buy 23,000. I may only choose to buy 22,000. So whenever I'm buying a new hedge, or it could be a higher strike in the same with the same expiry, or it could be a same hedge in the next expiry. I want it to be broadly about 10% away from the way the market is. So that determines where I'm going to buy the hedges. So if I'm doing the rollover, currently I don't have December 2025 hedges. I'll be start buying those hedges in October and November. So before November ends, all my hedges would have transferred from December 2024 to December 2020.
Okay. So basically yearly rollover, which you are following, right?
Yeah. Yearly, on a yearly basis, I just roll over. I'm more than happy to give the cost of ensuring my portfolio. That means my portfolio is doing well.
All right. Thank you. Thank you very much.
Thank you, Ramachandranji. So I think I just, while you were answering, I looked over all the questions on the chat box. by this answer, I think you have covered most of the questions which have been asked in the chat box. If anyone has any question related to strategy, you can just raise your hand and we'll unmute you. And till we see any hands being raised, Gauravji, I can ask my most important question probably in this time. Is that I don't know whether you're comfortable answering this, but I'll just read out the questions. So, when you became a full-time investor in 2006, what were your plans? Where did you see yourself in 20 years? I know everybody, none of us has a clearly laid out book where we see ourselves, but we'll have some idea. And today, when you have actually gone through that period of 20 years, how would you reflect back on your journey of 20 years as a full-time investor in the market?
So frankly, when I quit in 2006, I thought making money in the stock market was quite easy. My portfolio in the 3 years before that had compounded at more than 100% a year. So I thought even over time, at least I can make money 40-50% annualized basis. So it was easy going, and you just do the modeling on an Excel sheet. Enormous amounts that can play out over 15-20 years. So so the big lessons kicked in 2008 correction when those drawdowns. So before that, I always thought every year my portfolio will only increase in size. And when those corrections happened, uh, first of all, it totally changed my psyche. From a perpetual optimist, I started becoming a pessimist to the point I would always only see the downsides on everything that I try to do rather than the upsides. So that became a big challenge. Uh, and The other thing was whether I lost my confidence that whether investing could ever be a full-time profession. Like if you don't have money coming in from salary every year, how do you run a family? So it took me some time to get out of it. I would say, but yeah, so I would say 2009 was the period where the kind of things you were talking about, I finally set out to do. Uh, on an Excel sheet, what I did was that I modeled out the last salary at which I was when I quit in 2006. I modeled if that salary grows at say about 15% a year for the next 20 years. So that salary would
50%.
no 1.5.
Okay.
So what that salary would look like, assuming इतना मैं पैसा उसमें से खर्चूंगा तो कितना बच जाएगा, and that's the pool. So that's I did, and simultaneously, so that was the number which was kind of the opportunity cost for me.
Mhm.
So I kept that number because it's very easy to model out. So I had those targets right up till 2020, 2030, sorry. So into the future, and I'll see every year I would check that out where I am basis that. So that was a goal. End of day, interesting exercise for me to ponder over, and I finally crossed my opportunity cost. I think in 2015 or 16. So, and I'm assuming that the portfolio value of whatever I had was was put in debt and the returns on the debt. So that added to my opportunity cost, but it was in debt, not in equity.
Okay.
So the two things broadly would have said if I'm out of the market and I've washed my hands off equity, this is the potential returns I will make, which is a typical executive would end up doing. While my batchmates from IIM Canada, a lot of them do invest in equity, but the allocations are not so materially high. It could be 10, 15, 20% of their portfolio of their net worth. Whereas in my case, even till date, more than 90% of my net worth would be in equity. The remaining 10% is the amount I've taken out, that FD made in November 2008 being one of them. Is I've taken out that money out of the market, which is, I think, is good enough for me to sustain my lifestyle. So even if that other 90% goes down to zero, the lifestyle standard that I've been able living in, I think I can continue maintaining that for the rest of my life. So to having said that, that opportunity cost I only took care of in 2015-16. So it was 10 long years before I felt I was a success.
Great, great. Wonderful story. I think that that FD will always remain there, and you can tell stories about that to your grandkids as well.
I do so. I do refer to it. So it always evokes a laugh from everybody.
So thank you so much, Gaurav for sharing all these important, because see, of, of course we all can't even think of imagining what kind of pain you have gone through during that period of 2006 to 2013. But at least uh, by
No,
listening.
the first 2 years were very enjoyable. Let me not. So it's only so yeah, October 2008 to 2013. So before that, the things were playing the way I thought they would. So
No, the main point is that when we listen to these kind of stories, the main driving point is that we should not take things for granted, like how the market has been behaving in the last 4 years. Of course, we all of us have made money in our own ways, whatever allocation we have done in whatever kind of asset class we have done, as in small cap, large cap, or micro cap, whatever. But we all have broadly made good money in the last 4 years in all our individual portfolios in general. I'm excluding the one who are only into the option tradings. So, but
so
but we shouldn't take these things for granted. That is the main
absolutely.
learning.
So
Yeah.
so good times follow bad times, follow good times. So that's the cycle that we have. A few raised hands. Maybe we
Yeah, yeah,
can.
yeah. I'll just come to them now. So, I think iPhone 13, I'm unmuting you. You have not shared your name. If you would like to share your name, that would be great. Yeah.
Hi, sorry, my name is Aditya.
Yeah. Hi, Aditya.
I had just one question. You said something about position sizing. So you said if you had 1 crore in your bank account, you would take only options of, I think, selling put options. So my question is specifically on selling puts. So if you have 1 crore cash, you calculate how much to sell the put on. Is it basically if I have to take delivery of that put, that entire 1 crore will be used for that, or how do you calculate sizing for that trade?
Yeah. So if I have 1 crore of bank, so first of all, I'll buy liquid funds and play those liquid funds, so that I'm earning some money on those liquid funds also. So with a haircut, I only effectively on 1 crore, I only get 90 lakhs. So 90 lakhs is the margin money. Now using that margin money, my exposure by selling the puts could go as high as 3 crores also, maybe higher depending on the underlying. So what I'm trying to say is that I will only sell 1 crore gross exposure of puts. I will not sell more than that, even if that means I have a lot of margin that is lying underutilized. That underutilized margin is largely used to manage my positions in case the things go against against the plan and the trade is in trouble. And then we will use the rest of the margins to kind of build positions to counter those trades. So they are that remaining margin is used to manage my position. Does that answer your question?
I hope, Aditya, that
Yeah. No, I think so. You're basically saying that even though the brokerage will give you 3x, 4x on that amount, you will not sell options calculating that itna margin over there, because if you get
Yeah.
called, you're screwed.
Yeah. So I don't want to make leverage on that. I'm using options to kind of allow me to do different views on the market, a long view, a short view on the underlying. So that's largely the position I'm taking. I'm not using it to leverage or magnify the returns out there.
But when you're selling the put, you're trying to collect some. You used to do that.
First
I
of
think you
all, I
stopped
don't
now.
sell puts, yeah.
Ah.
First of all, I typically buy puts. I don't sell.
You stopped selling puts. Okay.
Well, I've
Okay.
never historically sold puts, but I till March 2020, I didn't even buy puts, the hedges. It's the
Okay.
correction of March 2020 that made me learn about buying puts. So because I started doing covered calls post the 2008 correction. So post that there was never a big corrections for me to feel कि covered call portfolio में बहुत बड़े drawdowns आ रहे हैं. जो आते थे वो they were manageable. But in what happened in March 2020, it before that my option strategies, covered call option strategy was up about 23% for the year. And in that single month, from that 23% positive return, it became about a 4% negative return. So I just realized that because I'm building those returns month by month gradually, and then I
Losing
should
in one
also
shot.
buy
Yeah.
hedges for that in order to protect my downside. If I'm going to spend 2-3% on buying those hedges, I'm fine with it.
Got it. And liquid funds, you said you would first take that cash, put in liquid funds. Is that Nifty Bs or that's something else?
You can do either Nifty Bs, not Nifty Bs, liquid Bs.
Oh, that's just overnight repo rate or whatever, right? Okay.
Yeah, you don't want to take risk on that. Yeah, underlying has to be safe. Matlab, then you're just magnifying, you're trying to leverage. If Nifty Bs are there, then even if you're making money on your covered calls, you'll lose money on your Nifty Bs.
So you take that liquid Bs and then, okay, got it. But yeah, you lose 10% on that, right? Suppose you don't put it in that liquid Bs.
So yeah, 10%. Even if I lose because the hedges are 10% away, I'll make about that or more than that by selling the calls on top.
Okay, got it. Okay.
I'm also selling calls. Don't forget that.
You're only selling calls, no? I thought that's your strategy. What?
No, not only selling. I buying the underlying ones.
Okay. Yeah. So covered calls. Yeah. Okay. Got it. Okay. The put तो आप छोड़ ही दिए. Okay, ठीक है.
And
Okay. Thank you so much.
Thank you, Aditya. Okay, I'll just move to the next. There's someone by the acronym HR. You can also probably share your name and ask your question. I've asked you to unmute.
Yeah, Ankit, am I audible?
Yeah, very much.
Yeah, Ankit, my compliments to you on the work that you're doing. And Gaurav, I've been following you since a long time, since I think you used to be the IR of Apollo Pipes, etc. Most probably not many people know that or used to know that at that point of time. So I just had a couple of questions over here. So kind of, अब 6 महीने का नहीं करते हो because of the cost itself, right? Actually, you look at 1 year long dated and not 6 months long dated, mostly because of the cost and because of the timing factor, right? Because again, you're saying that 6 महीने में आएगा correction.
yeah, matlab, I'm trying to do the maximum, and practically the maximum I get is 1 year. अगर मेरे को 2 साल का मिलता है या 5 साल का मिलता तो मैं वो करता.
Okay, got your point. Yeah, I think you already touched upon that. And I just wanted to say, kind of very quickly understand this 30% of the portfolio hedging calculation, because I didn't understand that part. Because, so for example, if I've got 1 crore ka portfolio right now, and if I'm buying 23,000 per strike, I would end up taking most probably 500 Nifty options, 23,000 strike of December.
We are only hedging 30% of that, na? 1 crore 30 lakh चाहिए हमें. So 23,000 into 125 crore, na?
So here I'm taking it as 100%. So 1 crore ka 100%.
And then you're deciding that you want to hedge 100% of your portfolio. I've decided to hedge only 35% of my portfolio.
Yeah. So I'll just come to that. So basically, if the Nifty goes down to 21,000 actually, so most probably यानी अगर यहाँ से अगर VIX, let's say that okay triple B हो जाता है, I might end up making most probably 12 lakhs on this 23,000 ka expiry if I have got 10 lots, basically 500. So my question was that portfolio comes down by 25% and I make 12 lakhs over here. So net I'm losing 12 lakhs
Portfolio
again.
25% से कैसे correct हो रहा है यार? 21,000, 26,000 to 25,000, 21,000 would be about 18%. if I get my calculation.
मैंने थोड़ा और बीटा ऐड कर दिया. So I just wanted to understand that okay वो 30% का हिसाब किताब in short basically because
So 30% is यार कि अगर it's a function of where I see the market. मैंने आपको निफ्टी का प्राइस टू बुक हाईलाइट किया ना, वो 5 से ऊपर जा चुका है, तो मुझे महंगा लग रहा है.
right
अब क्योंकि मैंने अभी डिसाइड किया कि मैं 30% हेज करूंगा. अब जैसे अगर जब मैंने ये हेजेस स्टार्ट की थी तब इंडेक्स 22,000 और 23,000 के बीच में था, तो वो पिछले साल के लिए 30% था. अब अगले साल के लिए पहली बात मैं अब जो मेरे 21,000 पे हेजेस हैं वो मैं उनको 23,000 पे लाऊंगा. तो 23,000 पे अगर मैं हेजेस ले रहा हूँ तो मैं फिर 30% ऑफ द पोर्टफोलियो के लिए नहीं ले रहा ना, मैं उसके बाद अब उसको बिटवीन 40 to 50%. तो जैसे जैसे मार्केट ऊपर हो रहा है मतलब और महंगा हो रहा है, मैं अपने हेजेस की क्वांटिटी भी बढ़ा रहा हूँ.
right
तो आई डोंट वांट टू स्ट्रेट अवे गो डाउन टू 100% बिकॉज देयर इज अ कॉस्ट ऑफ हेजिंग एंड देयर इज ओनली सो मच. तो मतलब ये मेरे केस में 30% है, आपके केस में 100 हो सकता है, मतलब दैट्स इज एंटायरली, मतलब इसमें कोई स्टैंडर्ड रूल्स तो है नहीं. सो आई एम हेजिंग
yeah
30% ऑफ माय पोर्टफोलियो, यू मे चूज टू हेज 100% और मे बी 150% ऑफ योर पोर्टफोलियो, नोबडी इज
right
स्टॉपिंग यू. बट
right
देयर इज अ
right
कॉस्ट टू इट, सो यू हैव टू फैक्टर इन द कॉस्ट. अगर कॉस्ट बहुत ज्यादा हो जाएगी तो वो आपको कहेगा यार ये तो बिना बात के पैसे दे रहे हैं.
right okay
Plus, the
and
market can remain irrational for longer than what we can think of. So we don't know. Yeah.
नहीं, इरेशनल की बात नहीं, आई एम हैप्पी यार, आई एम हैप्पी कि मार्केट इरेशनल रहे, बिकॉज मैं तो 100% इन्वेस्टेड हूँ और मैं पैसे बना रहा हूँ.
नहीं नहीं, लेकिन मैं इनकी बात कर रहा हूँ. अगर आप 150% हेजिंग करते हो
हाँ, नहीं तो उसमें
और
ऐसा नहीं है कि यू आर गोइंग टू लूज बिग मनी, यू स्टिल गोइंग टू मेक मोर मनी ऑन योर पोर्टफोलियो देन यू आर लूजिंग आउट हियर. प्रॉब्लम विद दैट इज आप कह रहे हो मैं बिना बात के वो पैसे खर्च रहा हूँ.
हाँ, मैं वही तो बोल रहा
एडवांटेज है,
हूँ.
एंड
एग्जैक्टली.
आफ्टर डूइंग इट फॉर अ कपल ऑफ इयर्स यू विल स्टॉप इट. The
एग्जैक्टली.
strategy should be there that you're continuing to do it even 20 years from now.
राइट 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 राइट.
right and hedging in this case doesn't mean that okay when the nifty comes down the the money that I make on my hedges is equal to the losses that I'm making in my portfolio. That doesn't
No,
need
no,
to
no,
be
no, no,
equal
no,
to
no.
the hedge.
See, first of all, I don't want to make money on the hedges, because if
Yes.
I'm making money on the hedges, that means that I'm losing money on big money on my portfolio. One. So my agenda is not to make money on those hedges. But in case the correction kicks in and these hedges are making money, then all I'm saying is if the correction is material, so let's say that market corrects, अभी मेरे पास hedges पड़ी हुई हैं और by March of 25 the market corrects to 21,000. Okay, मेरे पास 23,000 की पुट्स हैं, बट मैं उसमें अपना प्रॉफिट थोड़ी बुक करूंगा उन पुट्स में, मैं उनको लगा रहने दूंगा.
Right
तो मैं अगर अब दिसंबर में हो सकता है वो 21,000 जाके वो वापस आ गया होगा 24,000 पे, 25,000 पे.
right
तो अब इसका मतलब हो गया मेरे हेजेस पे प्रॉफिट हो रहा था, मैंने नहीं बुक किया और वो फिर से जीरो हो गई. आई एम टोटली ओके विद दैट.
right
मैं
okay
अपनी हेजेस को हटाना नहीं चाहता. सो एक बार
correct
मार्केट नीचे आके अगर रिबाउंड हो गया, अल्टीमेटली मार्केट ने ऊपर ही जाना है, नीचे तो जाना नहीं है.
right
और वो ऊपर चला गया, आई एम मोर देन हैप्पी बिकॉज मेरा पोर्टफोलियो में भी रिबाउंड आ गया.
okay got it yeah. And maybe one last one, say kind of when we are talking about covered call strategy, so basically you're talking about say kind of selling the out of money call options for a particular stock, for example. Kind of वहाँ पे भी आप कुछ parameters देखते हो या फिर is it just kind of is it discretionary kind of or maybe are there any parameters you look at, maybe X percentage or whatever? I don't know, just hypothetical.
No, I didn't understand. Could you repeat what you're trying to understand?
So for example, say kind of Havels, for example, was at 1500. I'm long Havels at 1500.
Mm-hmm.
Part of my covered call strategy, most probably I'm selling 1700 ka call on Havels. So that is spot 1500 पे 1700 strike का मैं calls sell कर रहा हूँ. That's 200 rupees out of money. So basically my question is that okay, how do you determine that okay कितना out of money strike मुझे call sell करना है? Is it वहाँ पे भी कुछ parameters आप use करते हो?
तो यार आई ब्रॉडली मतलब एक दो क्राइटेरिया है कि आई वांट टू सेल कॉल्स ऑन टॉप व्हिच आर अबाउट 5 to 10% अवे.
Right.
And while selecting a stock, two criteria. I should have a fundamental view on the stock कि वो
Exactly. Yeah.
मतलब सस्ता है या रीजनेबली प्राइस्ड है. तो अभी तो सस्ता तो कुछ मिलता नहीं है, रीजनेबली प्राइस भी इज अ क्वेश्चनेबल वे ऑफ इवैल्यूएटिंग। तो बस मैं ये कहता हूँ कि बहुत महंगा नहीं है कि यहाँ से फटी ना जाए। तो मतलब आई डू टेक फंडामेंटल व्यू ऑन द स्टॉक. So that is one way way I filter the stocks. The other is the other big criteria is the IVs on the stocks. So I want more
Right.
premium. If the premiums are too low, so if, there's no point doing these covered calls on the likes of say a Reliance or a TCS or a Infi.
Right,
So
right, right.
उनमें premiums ही नहीं मिलते, so that defeats the purpose.
Got it. Yeah. Sure.
Thank you so
Okay.
much.
HR, I didn't get your name. What's your name?
Hitesh Randhawa. My name is Hitesh Randhawa.
And you're based out of where?
Pune, yeah. I'm based out of Pune, yeah.
Okay, Desh. Good catching up.
Yeah, just one last question. Second, है कवर्ड कॉल में आप डाउनसाइड भी प्रोटेक्ट करने के लिए पुट और बाई करते हो या फिर सो वो भी करते हो आप बाय एनी चांस पुट बाई करके एक पुट सेल करके दूसरा पुट बाई करना बेसिकली कवर्ड
वो
कॉल स्ट्रेटजी में
वो तब करेंगे जब हमारी कॉल इन द मनी आ जाएंगी, तो हम क्रेडिट स्प्रेड्स डाल सकते हैं. बट इट्स
ओके
पार्ट ऑफ द मैनेजमेंट प्रोसेस एंड वी डू मैनेजमेंट बाय मल्टीपल थिंग्स. तो मतलब जस्ट टू स्पीक अबाउट वन थिंग इन
एग्जैक्टली
आइसोलेशन. But if you are more interested in this, why don't you ping me on DM on my Twitter account? We'll connect from there. ठीक है, अगर आपको
no
you
worries,
seem
yeah.
to
I
have
have
already done that. You just ping me on DM.
We'll
I'll
do that,
just
yeah.
share his
Send an
Thank you.
number.
email. So my
I'll share his
email is
number with you, or you can directly talk also.
sure. You can share the
Sure.
number. We can connect.
Yeah, yeah.
Sure, thanks.
Thank you so much. So I think we are already at 1:35. Since
ठीक
there
है,
is
we'll take the
one,
last question and call it a day then.
yeah. We'll take just last question. So Arpan, I've unmuted you. You can
Hi,
ask.
thanks for this session. I have a very quick, naive question. So, is it possible to hedge a specific stock? So, for example, is it possible to buy long-dated put options for, say, Infosys?
No. In most of the stocks, the liquidity is only on the near month option. The even the month after that, the liquidity is not there. Maybe it's there in Infosys, but majority of the stocks, even a month, more than a month away, there's no liquidity, and there are no year-long dated options in stocks. The dated options, long-dated options, are only in Nifty. That's that's the vagary of the Indian stock markets. That's how the regulator has chose to do it.
Okay, got it. Thanks.
Sure.
So I think that brings us to the end of the session, Gauravji, and thank you so much. And it makes why I'm saying thank you. I say thank you to all the guests, but more especially to you, because I know that you don't come on public forums and you don't have anything to gain from what we have done today. So you have only done to help this to me and my community over here. So that makes it even more special for me. So thank you so much for doing it for us. And I hope all the participants who were joining live or people who will be watching the recording on YouTube or on our platform will gain a lot out of it. And I'll just repeat one of my best learning from today's session is that use options for hedging, wherein basically and the best way to understand hedging is how you take health insurance. You don't get ill every year, but you still pay health insurance companies your premium. If you want to adopt options as a strategy to hedge your portfolio, you should look at it from that perspective. Then only in the long run you can get the benefit out of it. So thank you so much, Gauravji. And just before going, if you have any closing comment, that would be very, very, very helpful.
So thanks, Ankit, for saying all that. I think it was quite interesting experience. Answering all those questions brought back a lot of memories, and it's always a pleasure to be here on your platform. I think you and your platform, they're doing a good service. You are there on social media, but to that extent, I do think you realize your fiduciary responsibility, and you're not trying to misguide people just to earn members for your platform or anything. So that's one of the reasons the way you have done it. I appreciate that. And thanks everybody for being here. It was time well spent for me too. And wish you all the best for your investing journey. Thank you.
Thank you so much, Gaurav ji, and thank you so much, everyone. Have a nice weekend.